Broadly, you think there's three tailwinds still around for industrials, Barry?
I do. We're really recovering in the industrial sector and global manufacturing from a double-dip recession. It began with the trade war. In 2019, we had the first period since at least 1990 where global trade was negative when world GDP was positive. So we were just starting to get a bit of a recovery when the pandemic took hold. We're now recovering for both of those shocks. And you could see it in the ISM survey numbers yesterday, where production, orders, supplier deliveries, prices are all surging, but customer inventories are actually falling in the low 30s. So the strength of that recovery is going to probably persist through the entire year. That's sort of tailwind number one. Second tailwind is CapEx, which was affected by the same dynamics. The business confidence channel took a severe hit during the trade war. It depressed CapEx. Most of those companies, or many of those companies, are beneficiaries of stronger CapEx. So that's just getting started. And then there's a price effect there as well. So that's the cyclical case. The secular case is the industrial renaissance and the idea that stretching your supply chains all over the world just doesn't make a lot of economic sense any longer, and it carries a huge amount of risk.
Yeah,
so
okay.
That process is just beginning as well. So you've got a cyclical and a secular case that I think is going to benefit this sector through the entire business cycle.
Okay, Kerry, I know you think it's more consumer-driven, and also that given where the PEs are with historical averages for these industrials, they already have sort of priced in what Barry's talking about. Is that basically what your thesis is?
Well, Joe, I would agree with Barry that, yes, we're going to have a renaissance. We're going to have a lot of growth in industrials, but the market has priced a lot of that in. If you think of the moves for Caterpillar, Deere, Emerson as examples, they've had incredibly strong moves as if they're reopening stocks. They're cyclical, as we know, value to an extent, but they're not driven by the consumer. They're very high PE, same PE a year out as Facebook and Google, which we would argue have much stronger growth rates. And if you think about what reopening is, it's driven more by the consumer. So the type of reopening names that we think have more legs are those that are going to be helped by the stimulus plan. 1.9 trillion new money is going into the system. Most of that is into consumers' hands, not into capital spending and industrial. There isn't, unfortunately, a component in this plan for infrastructure. So we think that business will come back for the industrial sector, but we think these stocks perhaps need to pause because they've had this enormous run over the last few months, from really the time of the election through a couple of weeks ago when the market went straight up on the back of reopening names. And, you know, they benefited tremendously, which is fantastic. But perhaps those PEs, 28, 29 type PEs are a little stretched in the near term.
Shepard Smith here. Thanks for watching CNBC on YouTube.